Hello and welcome to this special series leading up to the ICICI Lombard Risk Manager Awards. On the show today, we're going to focus on risk compliance, risk management, and its role in times of a crisis. You know, I want to draw on your experience because we've just got one fundamental objective in this conversation today, to draw on your experience and understand how can risk management, how can risk compliance help organizations and companies like yours in times of crisis. But first, what do each one of you think of when I say risk management, when I say risk compliance? This is a question that goes out to each one of you. Mr. Vaidyanathan, you first.
We define risk in three parts. One, events that can impede your objectives. Two, uncertainty that you have to live with. And three, which is the most important, vulnerability that you have created for yourself. A combination of the three represents risk management. It gets implemented on a step basis at the lower end of statutory regulatory compliance to operational risk management, to business risk management, and strategic risk management. And depending on the subject on hand, the time frame for it is wider, and the person overseeing that specific risk goes higher in the organization. Where it helps organizations like Mahindra's, our approach to risk management is there are certain things you do structurally, i.e. as an organization you set a set of non-negotiable values in the organization. What it does is it takes away a lot of the dissatisfiers in the system. And a few things that you do proactively, which is in the marketplace, in dealing with your business partners, whether it's technology providers, bankers. So the framework for us in risk management is what is going to happen as an element of uncertainty. We don't know what that would be, we can guess, but let us prepare ourselves at all times to be better positioned to handle that.
Again, simply the phrase risk compliance, risk management. What does it mean to you at Magma?
So what it means for us is process. So we are into retail lending. For every single transaction that we do, we have multiple touch points with the customer. So we have to manage the process. So for us, risk management, once we have measured the risk on a customer, we have then got to manage the risk. And that management of risk is through a process. So everything that we do is process. We do not do anything outside of process. So for us as a culture, it is to stick to the defined line, stick to the defined process, and then manage the customer from the entry to the exit, the life cycle of the customer.
Well, it's interesting to go get both your perspectives, but what I'm going to ask Mr. Shetty to do is draw up the laundry list, and it can't be a long one. So a couple of 3-4 elements which you consider best practices.
The risk management is not the job of only the head of risk. Risk management is the job of everyone in the company. I think that is fundamental. Second is the concept of how do you embed the culture of risk across the organization, right? Third, clearly who are the owners of risk? Again, everything is put on to risk management. They are not the owners. They help you, they facilitate, but the owner really has got to be a CXO level or a board member really to manage key strategic risks. And fourth, I think a best practice today is really to look at the environment and say, earlier risks were one-dimensional, today it could happen from anywhere. And I completely agree with the definition. Identification, measuring, managing, and also responding sometimes to something that you could have never planned for.
Mr. Jain, you've heard what all three gentlemen have to say. What's the element that we've missed out when we're talking about risk compliance and risk management, primarily in the Indian context?
We hear a lot about companies saying, when do I start risk management or when do I end? And our answers to that is typically that there is no end or there is no beginning to risk management. It's an ongoing process, and it's an investment that we would make in the processes, in the culture, in the corporate governance, because ultimately when you talk about risk management and corporate governance, even a person who just started into business has to address issues like governance, transparency, dealing with the customers, dealing with the suppliers in a manner that brings confidence to them. So risk management brings about the culture changes and gives the confidence to the organization to portray to the market, yes, I have inbuilt structures that can help me and sustain shocks of the world.
Okay. Our focus today is on crisis management and risk as it relates to crisis management, i.e. how have you as a company, as an organization, built up your immunity? I think that's going to be a word I'm going to use liberally today, Mr. Vaidyanathan. How have you built up your immunity that helps you best handle and respond to a crisis that perhaps could be totally unpredictable?
Let me give you an example of what I call the ground floor and first floor. The ground floor is more operating and the first floor little more strategic. For example, one of the risks that we worry about is risk of concentration, whether it's on the supplier side or on our dealer side, which is connecting with the customers. So we consciously seek a level of diversification. In pure economics, it would appear suboptimal because instead of buying from one and getting maybe an additional discount, you consciously diversify to more than one supplier from more than one location, wherever possible. Similarly, the same with dealers. But you are willing to accept that cost as what I call the cost of insurance to ensure lower probability of disruption. So that's at the more operating level where we work with. But at the first floor, the strategic level, there are certain covenants that we work with. For example, learning from the 2002 crisis, one of the things that is an operative principle in Mahindra is concept of margin of safety, which is how much do you build your fixed costs. Now, the thumb rule that we use is 50%. Businesses could be at 40% or 60% depending on the nature of the business. But a margin of safety is a very simple principle to say manage your fixed costs to support fluctuation. So a 50% margin of safety essentially means even if I get a hit on my contribution or gross margin by 50%, I still will not go into red. So for us, risk management, as he said, is embedded into the way you run the business. So whether it's at the supplier end, whether it's in dealing with our bankers or dealing with new products, we've put in certain credo into the organization, which is helping us. Now, I must say, it comes at a price, and that's the insurance cost. You should be willing to.
And we'll talk about exactly how you evaluate the cost versus, the benefit, what that insurance provides. But we'll do that after this very quick break. Back in a moment. Welcome back to this special conversation focused on risk compliance, risk management, particularly in times of crisis. To a layperson like me, a crisis, well, it can take many forms, but the response can broadly be put into three areas of action: business continuity, data security, and people safety. Gentlemen, feel free to correct me if I've defined those buckets incorrectly, but I wanted to, really ask you again for a real example at Magma where a crisis, it could be any type of crisis, erupted and Magma had in place a system to, limit the damage from that crisis.
So, crisis in our context is, extremely localized. So you could have interpretation of a law stopping mining in a district, not even in a state. So if I were to take those examples and look at what we can do, and what we do is we track, for example, the freight rates in specific routes, and depending on how the freight rate has moved for the last 3 months, if required, we change our LTVs, which is what we fund to our customer. So if the freight rates have gone down, we will reduce our LTVs so that the customer's installment is enough to pay. So these are things which are small things that are done continually and not specifically, because the challenges keep changing, the challenges keep moving from one place to another, and so that's something specific. At a structural level, what we do is we diversify the portfolio. We don't have a single state where we disburse more than 10%. Within each of our states, we disburse about 7 products. So at any point in time, we try and, that's insurance that we talked about. We ensure that there is not too much of a lumpy exposure in a state, in a location, or in a product.
But when you talk about diversification, the thought also crosses my mind that diversification in itself opens up a need for different types of risk assessment, whether it's new markets, new geographies, all of that. But again, we'll dive deeper into that. Mr. Jain, based on the advice that companies have sought from you, where do you find the biggest gaps in their preparation for crisis? Nobody can predict the crisis. That's a message each of you has underlined again and again. But their preparation, where do you see the gaps?
I think one of the biggest gaps that we see in clients when we try to advise them on risk management and crisis management is a very good linkage between reputation and crisis management. So when a crisis erupts, it's definitely going to impact the organization's reputation, and reputation has a large stake when it comes to damages to profitability, damages to the people or to its society. So it's very important for companies to realize that when managing crisis, we ultimately also want to manage reputation. We want to put in structures in place, specifically with the leadership team, to better understand what crisis management is, how to respond to it, how to react to it in the media, in the press. So there are a lot of elements that a company could do to manage crisis, such as trainings, leadership trainings. Also get into understanding what are the elements that are going to take place in crisis, and we often see that speed is one element that is missing in managing crisis. So it's very critical and very important that you respond to a crisis with speed, and that is the crux of crisis management. Is this the more swift you are in crisis management, the more effective it is. And ultimately, we have seen a lot of examples of companies coming out of crisis in 3 months, 2 months, which are not really effective. What you want to do is to address crisis instantly and then take it head on, if you will.
The need for speed is underlined by him. Mr. Shetty, add to that.
So I think one of the practices which companies do is really have something called the loss events database, which is really identification of many events that have happened in the past and learning from that. So to give you an example, there was a beverage company in India which had a particular worm in the bottle, and they lost market share for over a year. It took them 1 year to regain back to the market share. And when Cadbury's had a similar incident, Cadbury's had planned a lot more in terms of coming back. So for example, whether in terms of consumer awareness of what messaging has to go about, bringing in Mr. Bachchan to basically talk about the safety of the product and that it is consumable. Third, the kind of packaging, for example, double packaging, which they had to ensure that no worms got in. So they suffered, but in 6 months they were back to the market share.
So you're saying they thought this through before the event, and therefore their recovery was faster. Is that what you're saying?
I wouldn't say that they thought through this event, but I would say that, for example, having cognizant of something which has happened, because there are many risks which are going to happen which you're not, for example, you can't plan for, but because of something that has happened in the past, your risk response is much faster and you know some of the actions that you could be taking. And that is what, for example, they did. And you have a similar case of, for example, Johnson & Johnson, which is very famous, where cyanide was found in their pills, and they, for example, recalled all of that. It was on the verge of extinction, the whole of the company, because of cyanide being found, but then they were able to communicate back and get back market confidence.
I just want to, I think there is only that much you can forecast, but crisis deals with unknown unknowns, and where, to me, it's a bit of rear view mirror which helps you. The crises don't exactly repeat, but they rhyme. And what you learn from a previous event, you bring it into bear in the current event. So, for example, the 2008, there were several parts to the global financial crisis, but one part that particularly affected manufacturing companies dealing with suppliers is the liquidity squeeze.
Yes.
A lot of suppliers did not, even though they were given credit lines, they were not able to draw on credit lines. What that tells you, therefore, is the manifestation of a liquidity crisis could take one of these forms. And then now we are far better prepared in terms of our dealings with suppliers, in terms of the extent to which we can support suppliers. So today, for example, we are a lot more proactive in that front, because having learned from there, you build better guards for the future. So you don't know what the event that would be, but what you would consciously look for is, how can I make the best out of a bad bargain?
So far, when we've talked about crisis, we haven't really touched upon crises that are of the nature of natural disasters, crises that are epidemics, health-related scares. We'll talk about that when we come back after this very quick break. Back in a moment. Welcome back to this special conversation leading up to the ICICI Lombard Risk Manager Awards. Today, our focus is on risk management, risk compliance in times of crisis. Crisis. I keep repeating the word crisis because that's the objective of our conversation today. So far, we haven't touched upon crisis, natural disasters. We haven't touched upon crisis like SARS. All of them throw up a whole host of challenges for companies. The natural disasters first, Mr. Vaidyanathan. I mean, you know, again, Uttarakhand, close to home.
The Uttarakhand one is more, truly a gut-wrenching, heartbreaking event. So just thinking about it, my hair stands. In terms of an organization, when you look at the unknown unknowns like these, you don't know when it will happen, but you always think this will happen. So things like fire, floods are not those you take chances on. So there are a set of preventive and curative things that you do. But to me, the larger point is it kind of should make people sit back and say that, are we sufficiently environment conscious? Have we brought environment into the business model? If you bring organizations to be a lot more sensitive, I'm not saying you can prevent a disaster, but you can certainly minimize disasters from happening, whether it's water, whether it's fire, whether it's gas leakage. Every crisis gives you a great opportunity to therefore put in place 2 or 3 big things.
Learn and course correct.
Correct. And so the big thing I would say is increase emphasis on sustainability, increase emphasis on risk-adjusted returns, make managements move away from the short-term to the more longer-term issues, and use a crisis, nothing like a crisis to drive home a point. Get a crisis to drive home that point that we want businesses to be sustainable to the larger ecosystem.
That's a large business group perspective. Do small and medium enterprises that in some sense still form the backbone of industry in India have the luxury of doing that? I mean, you know, you've had a variety of interactions, a lot from the small and medium enterprise space as well. When we're talking about these concepts, how many SMEs can implement them?
I think that's a very good point, because when we interact with the SMEs, we realize that They do not see the long-term vision of risk management, crisis management. These are concepts that they believe are for the larger organizations. So effectively what happens when we talk about risk management at SMEs is really getting down to, okay, how can I increase myself in terms of profitability? So, crisis management, I would say, is even further down the spectrum. They're still addressing issues of business, of profits, and they do not see the value of crisis management, of reputation risk, of managing people. There's a long list of risk management that can be done at SMEs. I think there's a long gap in that process.
Well, I suppose at this stage their capacity to take cognizance is limited.
Absolutely.
I mean, is that what you're saying? When you are, try and balance out your investment in terms of management, time, energy, financial resources, building up a team, building up capability to address the risk universe, and you weigh that against the benefits, how do you arrive at that right balance? Have you thought about that?
So it's my personal view that there is one overriding risk in the business of lending, which is credit risk. While environment and market and all of that, if we are able to take care of credit risk, I think we are able to address about 90% of the entire spectrum that as a lender I face. And just to come back on that environmental piece, how do we try and do it in the lending is give an example. So if I'm going to lend to a quarry owner or a mining customer, I look at the clearances that he has, the statutory clearances required as per law. And if he doesn't have those, we don't lend to such a customer.
One final thought from you, Mr. Shetty. We've sort of